Happy Friday, Brian Manning here with the weekly update. Let's get right to it. Monday this week, we've got new home sales. So this is signed contracts for new construction. This is running at a pace of 662,000 sales per year. Same pace for about the last 3 months. So seeing a lot of consistency there. We also got some feedback on new home sales for the median sales price. There's a lot of negativity about this in the media. And what I really want to remind people of is that median home price is not home appreciation. Median home price just means, for example, if we have a line of sales at $400,000 and more sales took place at a price of $200,000 to $399,000 and less sales took place at a price of $400,000 to $499,000, that just means that the median price moved lower because more sales took place in a lower price range. That's not home appreciation. It does not mean that prices went down. It's just an indicator of where the sales were taking place. It's not builder price cuts. Once again, you got to watch the media. They love their negativity, and it's just not. It's not negative news. Inventory was up a little bit. Inventory is at 463,000. The thing about new home inventory is that most of those homes are not started or completed. If we look at completed homes across the country, it only totals 85,000. So completed homes across the country are only a 1.55 month supply. That's still a seller's marketplace to see 1.55 month supply in new construction. So really strong numbers there. Tuesday of this week, we got Case Shiller. So Case Shiller is kind of the gold standard for telling us about home appreciation. This is for the month of January. Home appreciation was previously was up 5.6%. Now it's up 6%. So still, it's great to see the housing market being resilient. What's important about this report is that I would say homes selling in the month of January that are getting picked up in this report for home appreciation are people that were in the market really in the month of November. That's important because mortgage rates were really at their high end of October going into November. So still strong housing there. Thursday this week, we got pending home sales. Pending home sales was for the month of February. Market expectations was that pending home sales across the country would be down 1.6%. But guess what? Pending home sales were up 7%. So again, still great to see strength in the housing market. Today, even though the markets are closed today for Good Friday, we still got inflation report. The inflation report is PCE. It stands for Personal Consumption Expenditure. It's the Federal Reserve's favorite gauge of inflation. Let's take a look at this and see how this is working for us. It's pretty interesting to talk about inflation. So, reminder for everyone, the Federal Reserve has two mandates. One is price stability, one is employment in the US economy. If we're looking at price stability, the Federal Reserve is very focused on getting core inflation for the PCE, at 2%. And this is going to be tough. It feels like we're just stuck here right now. So the first thing we look at is this inflation numbers for the month of February. For the headline number, it was expected that inflation would go up 0.4%. It went up 0.33%, so a little bit better than expectations. The Federal Reserve is the most focused on the core rate. The core rate strips out volatile items such as food and energy. Core rate was expected to go up 0.3%. It went up 0.261. So now if we look at inflation on a year-over-year basis, this is what the Federal Reserve is focused on. This is what they're trying to get to 2% at. We went from 2.884 down to 2.784. Not a lot of traction there. We're slowly seeing housing come down. We've talked about this a lot in the past. Shelter makes up a large portion of this report. Shelter costs moved from 6.129% increase to 5.846. So not a huge adjustment there. We're slowly seeing it come down. What's really interesting to look at right now is personal income was only up 0.3%, but across the country, personal spending is up 0.8%. Savings rate is at 3.6%. It's the lowest number since December of 2022. Do you know pre-pandemic savings rate was at around 10%? It's almost like the country right now is just spending more than they're earning and living in a deficit. I'm curious to see at some point in time if this is going to have an impact, because if you're just living, in a deficit economy, at some point in time it has to come around. So we'll have to wait and see what happens there. Really to dial in just a little bit more on inflation to help you out, because again, the Federal Reserve wants to see core inflation at 2% before they start cutting interest rates. Other than that, they want to see unemployment tick up. So it has to be one or the other. Inflation has to move to 2%, or unemployment has to tick up to like 4.2%. And inflation is just not feeling like it's happening right now. So if we look at this, so our inflation number that we got was at 2.784%. If we look at the next reading that's going to come out, so the next reading comes out, it replaces a prior reading. So in March, At that point in time, the reading was that inflation was at 0.336%. So if we take our current reading minus the one we're going to replace in March, that gives us 2.448%. And then we're going to get a new reading April 26th. So this is upcoming. This is for the March reading. And let's just say the prediction there is that it comes out at 0.23%. So now core inflation moves from the 2.784 reading we got today down to 2.678. Again, the Federal Reserve wants this number to get to 2%, and this is sticky. It's very stubborn right now. It's not moving lower. Let's look at the rest of the year to see what happens. So here we are. We got our 2.678 reading right now. Now let's just say on a month-over-month basis for all of the rest of the months in the year, as we get this inflation report, inflation only goes up 0.2%. It might go up a little bit higher, but let's just say it's 0.2%. So that means the next readings coming out are going to be in June, right before the Federal Reserve meeting. We get this reading, we're at 2.5, 2.4, 2.5, all the way down to the November meeting. And at the end of the year, if inflation only goes up 0.2%, the lowest we get is a 2.564% reading on inflation, and the Federal Reserve wants this number at 2%. So for the Federal Reserve to really cut rates and want to make meaningful moves lower for interest rates, they want to see 2% right here. And if we're not seeing 2% right there, they're not going to get the meaningful moves that we're all hoping for. The only way we're going to see the meaningful moves is if unemployment ticks higher. So right now it's at 3.9%. Next week, I can't believe it's already going to be the first week of the month. Next week we get unemployment reports. So the first week of every month we get employment data. So that'll be March's unemployment reading. If that unemployment report moves from 3.9, 4%, somewhere in there, if we start taking up towards 4.2, that will end up being the catalyst for the Federal Reserve to cut rates. Not inflation right now, unfortunately, because we're just kind of like stuck in a holding pattern. I'm around all weekend. If you want to learn how we're closing purchase transactions in 10 days, give me a call. Pre-approval same day, give me a call. We'd love to help you. Happy Friday. Have a great day.